Hello students, good day to all of you. Today we are going to discuss a very important topic, that is inventory and its valuation. As we already know that inventory constitute a major part of the cost of production and cost of finished goods produced. So if any variation in the valuation of inventory is there among different organizations, then accounting system will not be comparable. So it's a valuation, that is the valuation of the inventory affect our cost of production. If the valuation of inventory is overcharged or undervalued, that is going to affect our cost of production as well as our the stock of the finished goods. It means our income statement, that is comprehensive income statement, and the statement of financial position is not going to give you the true picture. Its evaluation affect our current assets also, and its evaluation affect our liquidity position of the company also. So that's why it is very important that the asymmetries which are available in the evaluation process or in the evaluation methodology of different kind of organizations for valuing the inventory should be made comparable, and these asymmetries should be removed. So the question arises to us is why the inventory is very important, its valuation models are very important. First of all, because the basic purpose of accounting is to ensure the comparability, consistency, and transparency of the financial transactions which are occurring in the different organizations. Secondly, our objective is to remove the variety of valuation models so that the number of variants which are available in the valuation model, that should be removed. So to remove such kind of asymmetries and have a common consensus on the valuation model of the inventory, and also to help to determine the income of the organization, it is very important that we should have the system of valuation which is more acceptable to everybody. And secondly, it should ensure the asymmetries in the valuation model should be removed. So that's why the IES 2, which is issued by the International Accounting Standard Board, is promulgated. So as far as IES 2 is concerned, IES 2 deals with the inventory and its valuation model, which is developed by the International Accounting Standard Board. Before this standard, accounting standard comes into picture, there were a number of asymmetries. Every organization was following different kind of valuation models. So hence the accounting system which was developed was not having one kind of consensus. So the accounts of the different organization was not comparable. So if you want to compare the liquidity ratio of one company with the another company, if the same model is not followed, then you cannot say that these two figures are comparable. So with this purpose, International Accounting Standard Board formulated an International Accounting Standard 2, and the process of giving the accounting standard on the valuation of the inventory was started in September 1974, when an exposure draft on the valuation and presentation of inventories in context of historical cost system was first published. Then in October 95, International Accounting Standard 2 valuation of inventory was issued. And in August 1991, exposure draft, that is E38 on inventories, was published. So finally in December 1993, IS 9, that is inventory, was issued, and on or after it was applicable or on or after 1st January 1990. On 18th December 2003, IS2, which is on inventory, issued, and it was applicable from 1st January 2005. Apart from that, there are related interpretation, that is IFRIC 20, which relates with the shipping cost in the production phase or on surface mine, and similarly SICs 1, which deals with the consistency of the cost formulas as revised in the IAS 2, which was applicable from 2003. So in today's lecture, we will be discussing about the various provisions of the inventory valuation as per the International Accounting Standard 2. And we will be also discussing the first recognition criteria. Then we'll be talking about measurement criteria. And in the same way, finally, we will arrive at the conclusion regarding the disclosure practices which are required in the inventory valuation as per the requirements of the International Accounting Standard 2. So, as far as International Accounting Standard 2 is concerned, it is an international financial reporting standard produced and disseminated by International Accounting Standard Board ISB and to provide guidance on valuation and classification of entries. So inventory. So therefore, International Accounting Standard 2 is promulgated by the International Accounting Standard Board, and it discussed the various valuation procedures and models which the companies should follow, and it also described the classification of the inventories as per the requirements of the industry as well as the various spheres of the business. So let us discuss the IES 1, where the statement of financial position has been given certain guidelines. And in asset side of the statement of financial position, among current assets, the most important item is inventories. So its importance is arise from the fact that if this is not properly valued, if it shows different kind of asymmetries in the valuation models adopted by the different organizations, then the accounts will not be comparable and there will be no consistency, and you cannot say that the accounts are prepared with the true and fair view, because there are a number of chances if you are using the different methodologies by the different companies regarding the valuation of the inventories, then they will be having their own models which may not give you the correct view of the valuation of inventories in their organization. So this very important aspect, which I think by giving the IES2, the International Accounting Standard Board has done a very wonderful task. So as far as why this standard has been required, so as far as the valuation of inventory is concerned, it remains a controversial years for the many years, because we have already studied in the BCom that there are number of methods of the valuation of inventory. For example, we have FIFO method, we have LIFO method, we have specific identification method, we have HIFO, highest in first out method, we have weighted average method. So there are number of methods are available. So which method present a consensus view of valuation models among the industries, and which method helps us so that we can have the comparativeness of all the financial statements which are prepared by the different organizations. So this is a very crucial element, not only in the computation of profit but also in the valuation of assets for statement of financial position purposes. So valuation of inventory is therefore very crucial in determining earning per share. It is very crucial in the net asset backing for shares, and it is very important to interpret the current ratio also. So consequently, basis of valuation should be consistent so as to avoid manipulation of the profits between accounting periods and comply with the generally accepted accounting principles, so that profits are comparable between different companies. So therefore, keeping in view all these things, to ensure that the profit figure which is given by the company is absolutely accurate and comparable with the other companies, its valuation for current asset purposes to find out the liquid ratio or the current ratio is genuine. Similarly, its earning per share, if profit is overstated or understated because of the value different methodology of the valuation of the inventories, then the earning per share will not be appropriate. So therefore, net asset backing for share and the current ratio, you cannot say that these are accurate. So therefore, it is very much necessary that the valuation model which is adopted by the different companies to value their inventory, either it is opening stock or closing stock, for the purpose of finding out the cost of goods sold or the closing inventory or showing it as a current asset in the statement of financial position, it is very important that we must have some standard. So that's why valuation of inventory is very important. And it throw a need for having an accounting standard of inventory. So no area of accounting has produced wider differences in practice than the computation of the amount at which inventory is stated in its financial statement. So there was a number of variants which were available. There was no agreement on it. So because of the various differences in the practices in the computation of the amount of inventory, therefore it was a need that we must have a common accounting standard at the international level, which the companies should follow. And similarly, accounting standard on the subject need to define the practices and to narrow down the differences and variation in these practices so as to ensure adequate disclosure in the account. So whatever methodology which is prescribed in the International Accounting Standard 2 is followed by the different companies. There must be minimum variation, and secondly, there should be some disclosure requirement so that they must disclose how they have arrived at the different figures of the inventories in the financial statement, in the notes to the account, so that we can have a consensus view and a good picture and transparent picture of the organization, which is consistent and which is comparable with the other organizations. So that's why there was a need to have an accounting standard at the international level. As far as inventory is concerned, inventory valuation model has impact on different spheres of the valuation of inventory. For example, inventory valuation model has a significant impact on the financial statement of the organization. It impacted its comprehensive income statement. It's impacted on our statement of financial position. So similarly, a person who is a stakeholder who is taking decisions on the basis of these financial statements must be aware about the various kind of disclosures which are needed and how this figure has been arrived at. This is very important to disclose. So without accurate inventory valuation model, it can cause either understated or overstated net profit of the company, and also impact on the amount of tax payment by the organization. So therefore, we must have some kind of consensus on the valuation model which are adopted by the different organizations. So inventory valuation allows companies to provide a monetary value for items that can make up their inventory. So inventories are usually the largest current assets of the business, as other important as funds, for example, cash. So it is a form of fund tied up in the assets. So its proper or accurate measurement or valuation cannot be overlooked, as it forms a greater percentage of an enterprise current assets in particular and total assets in general. So therefore, we must have the standard for this. So there are level of inventories differ from industry to industry, and holding inventory significantly affect the nature of production process, production attributes, market demands, and raw material used in the production process. For manufacturing companies, it has been experienced that inventories usually represent approximately 20 to 60% of their assets. So, as it has been stated by the Morgan in his research in 2007. So, if the inventory is not properly valued, it may result that expenses and revenues not be properly matched, and the company could make a poor business decision that will affect the company's profit. So, it is very much appropriate that we must have the standard valuation model. So the basic purpose of IAS 2 is to provide standard valuation model, first for the recognition of the inventory, then after the measurement of the industry, and rightly at the end, we will have a consensus on the disclosure practices which are required to be made by the different companies. So first, let's talk about the inventory recognition. As far as IAS 2 is concerned, International Accounting Standard 2 has defined the inventory as assets, number one, those assets which are held for sale in the ordinary course of business. Those assets which are not held for sale, which are for the use in the business, for manufacturing process or for any other thing, which are not going to be sold, they will not be part of the inventory. So inventory, when we define the term inventory, inventory means those assets which are held for sale in the ordinary form of the business. Secondly, it may have been used in the process of production for such sale. For example, when you use certain material for converting the raw material into finished goods, so it may be in the form of material or supplies to be consumed in the production process or rendering of the services. So while recognizing any item as inventory, you must see whether they are kept here for sale in the ordinary course of business, whether they are to be used in the process of production for such sale, or it may be in the form of material or supplies to be consumed in the production process or in the rendering of the services. So as far as inventories are concerned, it refers to goods or other items a firm owns and hold for further processing. So it has many classifications, around four or five type of classification. First, it may be merchandise inventory. Secondly, it may be raw material. Merchandise inventory mean already they are in the finished goods format. Raw material which needs to be converted into finished goods. Similarly, you may have work in process on which some kind of processes has already been there, but some needs to be done so to make it a finished product. And fourthly, it may be in the form of finished goods. So we have the merchandise type of inventories, we may have raw material, we have work in process, we have finished goods. So all these four kinds of inventories are held for sale in the business. So that's why. So let's talk about one by one again. So merchandise, you buy finished goods and sell finished goods. So here goods are held for sale by the retailer or wholesaler. So you are not a manufacturing concern. You are just a retailer either or wholesaler. You are procuring finished goods from the outside, keeping it with yourself for some time and then sell it. Secondly, you are a manufacturing concern. You purchase some raw material, you apply certain processes on it and make it a finished goods and then sell it. And thirdly, we have the work in process on which some processes of the work has been there, but after that, that will be made finished goods. Similarly, finished goods, all the processes has been completed and the goods are ready for sale. So by elaborating the definition as given in the IAS 2, we can divide the inventory into four components, that is merchandise inventory, raw materials, third work in process, and fourth is finished goods. Now let's move the elements of various inventories are: number one, if your merchandise goods purchased and held for resale, finished goods you produce, work in process, and raw material awaiting use in the development process. So in this way, we can have different elements of the inventory for use. Now, there are certain kind of things which are lying in the organization. They may be covered under the definition of the inventory, but IS2 will not be applicable to them, because for such kind of things we have separate international accounting standards because of their special nature. For example, let's talk one by one. First is work in progress arising under construction contracts, including directly related services. Now, for the purpose of the construction contracts, we have IES 11 that is related with the construction contract. So here the provisions of the IAS2 will not be applicable. Similarly, number two, when you have financial instruments, so IAS 32 financial instruments and presentation, and IAS 39 financial instruments recognition and measurement. If such kind of inventories are there, maybe in the form of securities or financial instruments, so there IAS 32 and IAS 39 are applicable. So that's why it will not be applicable there. Similarly, the item which are related with the biological assets related to agricultural activity or agricultural produce at a point of harvest, for that IAS 41 is applicable. So measurement rules do not apply to producers of the agriculture and forest products and commodity broker traders. So for that we have the separate international accounting standards. So therefore this may also be said to be the scope of IES2. So IES2 do not applicable become applicable on the construction contracts, financial instruments, and agriculture and its related activities. So it is applicable to the others. So if it is covered under these four, so we will not apply IES2 there because of the special nature of the transactions. We will apply their applicable standards there. So next part is the measurement of the inventory. Once we have described whether it is inventory as per the IES2 as we have discussed earlier, then the question arises before us is how to evaluate or measure the inventory. So IES2 require that the amount at which inventory is stated in the periodic financial statement should be the total of lower of cost and net realizable value of the separate items of inventory or of groups of similar items. So here it is very important to segregate this statement. Number one, inventory is valued differently. If different types of items are there, separately we will determine the value of the inventory. The methodology which we will be using, that is lower of cost or net realizable value. So two things are very, very important. If cost is lower, we will evaluate it at cost. If net realizable value is lower, then we will value it at net realizable value. So this standard emphasize the need to match cost against revenue, and it aims like other standard to achieve greater uniformity in the measurement of income as well as the improving the disclosure of inventory valuation model. So different methods has been prescribed under the IAS 2 for valuing the inventory. Number one, we have to find out the cost. Which cost? Because items are purchased at different points of time, they have different prices. Cost model we have to adopt. Secondly, we have to compare it with the net realizable value, and for doing that we have to arrive at the uniformity, greater uniformity in the measurement of income as well as improving the disclosure of inventory valuation model. So as far as methodology is concerned, very simple. For the measurement at the lower of cost, and second is net realizable value. Now cost, will be defining costs separately in this presentation. What is included in the cost, whether only purchase price is included or whether some things other is added to that, or there are certain specific items which are not added to that cost we'll be finding. And secondly, we'll be finding out the net realizable value. So before explaining the things regarding the cost, what is included into that, what is not included into that, we will first define the net realizable value. What is net realizable value? So net realizable value is the selling price in the ordinary course of business. So in the ordinary course of business, not under special circumstances, the item which is lying with you in the form of raw material, in the form of work in progress, or in the form of finished goods, what is the net realizable value? That is, what is the selling price of that item in the ordinary course of business? And from that, we will deduct the estimated cost of completion, and we also deduct the estimated cost necessary to make the sale. So first we will determine the selling price. For example, you have work in progress. You will find out if it is in the form of finished good, what will be the selling price. From that, estimated cost which need to be incurred to convert that work in progress into finished goods, that will be deducted, and the estimated cost necessary to make the sale will also be deducted, and you will arrive at the point net realizable value. So this notion of net realizable value with the compare will be compared with the cost, and the lower of cost or net realizable value at that point will be measured in the form of inventory. So let's uh, things what is included in the cost of the inventories. So the cost of inventories, because we have used the term cost of the inventory as well as the net realizable value. So let's come to the cost now. So as far as the cost is concerned, cost of inventory is the aggregation of the cost of purchase. When we say that the cost of purchase, that means we include purchase price, we include import duties, we include transportation costs and handling costs. So net of trade discounts and rebates. If you have got some trade discounts and rebates, that will be deducted from that. So secondly, it will include cost of conversion into finished goods. For example, you have purchased the things in the raw material format, then you have to convert into the finished goods. So whatever the amount of labor and production overhead cost needs to be spent upon that, that will also be included. And similarly, there may be certain other costs in bringing the inventories to the present location and condition, excluding the cost of abnormal waste, storage, administration, and selling. So all these costs, cost of abnormality, cost of wastage, storage, administration, and selling and distribution costs, they will not be the part of the total cost of inventory. So while evaluating the inventory, we must see that the cost of inventory should include the purchase price plus import duties plus transportation and handling costs, and if any trade discount or rebates has been received, that will be deducted out of that. And if it is in the form of raw material, then if you have to do some conversion of finished goods, whatever cost is required, that labor and production overhead will be added. But certain costs like cost of abnormal wastage, storage and administration and selling expenses will not be added. So let's elaborate it further. So cost of inventory include purchase cost plus cost of converging the raw material into finished costs, and other costs incurred in bringing the inventories to the present location and condition. So we have to add up all these three costs to value the inventory which is lying in your organization, or to arrive at the cost of goods sold. So inventory cost, there are certain things. Inventory costs include any cost to bring the inventories to the present location and condition. It may be in the following component: purchase price, we have already explained it, import duties, non-recoverable taxes, transport handling costs, etc. Conversion cost may include direct labor, direct variable overhead, fixed overhead, only applicable if you purchase inventories and further process them, mostly applicable to the manufacturing company. Any other cost to spend to bring the inventory into present location and condition, it may include interest cost, cost to design products. So in inventory costs are recorded of net of rebates and discounts. So if you have any received any kind of rebates and discount while purchasing the inventory, that should be deducted from the total cost of that inventory. While making the inventory valuation, you must look into that. Now there are certain kind of other inventory costs also which are need to be included, and for that purpose we use the methodology of absorption costing, both for fixed kind of expenses and variable costs included in the inventory, and allocation of fixed and variable overhead. For that purpose we may be using some amortization methodology, maintaining, for example, factory building utilities as specific to the manufacturing organization. Similarly, there may be storage costs necessary to the production process, not for the sale. If final goods are stored in the storehouse and some storage cost is there, that will not be included here. Similarly, amortization of certain intangible assets may be there, that is development costs, spend time in developing a new product that you are selling. So similarly, some kind of borrowing cost if inventory takes time to get ready for use and sale. So before the inventory gets ready for sale, you spend anything, that will be included in the cost of inventory. And if normal waste is there, that is included in the inventory. If abnormal waste is there and expense, it is not a part of the inventory cost, that will be charged to the profit and loss account, but it will not be part of the inventory cost. So these things we should keep in mind while developing the valuation model or while valuing the inventory in our organization. These are certain specific things which need not to be included in the inventory cost. One is inventory storage cost. When the goods are ready for sale and you hold it for selling purposes, so this cost, inventory storage cost, is not going to be part of the inventory storage cost. Similarly, abnormal wastage, it may be in the form of material, it may be form of labor or any other production process, that will not be a part of the inventory cost. Similarly, if you spend some administrative expenses, these are not part of the inventory cost. Similarly, selling costs are there, they are not part of the inventory cost. So these are the items which are not included in the inventory cost. So let us take a case study here. Here a case is presented to you. ABC Trading Company purchases motorbikes from several countries and sell them to the European countries. So during the current year, this company has incurred following expenses. One thing is, now ABC is a trading company, it's not a manufacturing company. So whenever you value the inventory, you must first determine whether it's a manufacturing concern or a trading concern. So now in this case, it's a trading concern. So various kinds of expenses has been there. For example, trade discount on purchases there, handling cost relating to imports is there, salaries of the account department are there, sales commission paid to the sale agent, after sales warranty cost, import duty, cost of purchases on the basis of invoices we have been given, freight expenses, insurance on purchases, brokerage commission paid to the indenting agents has been given. So what the ABC company desires from you, they say that on the basis of the requirement of the IES2, you discuss what is included in the cost of inventory. So here, let us discuss the item. So item number one, which is trade discount on purchase. Item number two, which is a handling cost related to purchase. Item number three, which is a salaries to the accounting department, that is not included. Item number four, sale commission paid to the, it is relating to the sales, so it is not included. So after sale warranty cost, this is not a part of the inventory cost. Six, import duties, yes, it is a part of the cost. Cost of purchases, it is a part of the cost. Similarly, freight expenses, it is a part of the cost. Insurance on purchases, that is a part of the cost. So brokerage commission paid to the intending agents, that is also part of the cost. So here the item number one will be deducted from the total cost because it's a trade discount on purchase. Item number two, handling cost, will be added. Item number 3, 4, 5 are not part of the cost of inventory. Item number 6, 7, 8, and 9 and 10, they are allowable for the calculation of the cost of the inventory. So sales of the accounting department, salaries of the accounting department, sales commission, after sale, warranty cost, these are not to be considered as a cost of the inventory. So therefore, they are not allowed as per the IS2 for inclusion in the cost of inventory. So this case study explain you what are the various kinds of costs which are included, what are the various kinds of costs which are not included. For doing this purpose, you must follow this formula, because we have to include only these kind of costs. For example, purchase cost, cost of conversion, other costs which are incurred in bringing the inventory to the present location and condition. So these are to be included. Other items which has been specifically stated here need not to be included as per the requirements of the IAS2. So similarly, there are this methodology, this IAS2 has suggested certain models which needs to be discussed here. First, this inventory valuation model which has been suggested are, first is first in first out, second is weighted average cost method, and third is specific identification method. So LIFO method, which is not stated here, is not allowed. So we know these kind of methods. So first in first out method is older stuff, the item which is purchased first will be go out. So older stuff sold first, new stuff remains in the ending inventory. Secondly, weighted average cost method. So beginning inventory cost plus purchases to the cost date divided by the quantity of the inventory plus quantity of the purchases to date. So whatever will be there, we will be finding out the average. So total cost divided by the quantity of the inventory and the beginning plus quantity of the beginning till date in the organization is holding. So with that, we will divide and find out uh, the purchase price or the weighted average cost for that. So you then allocate the average cost to the ending inventory and cost of goods sold. So weighted average in calculation is dependent on whether a periodic or a perpetual method is used. Both periodic and perpetual method is need to be discussed, and we have already done it at the graduation level. So one is another, which is a specific identification method. So here we will find out the which nature of inventory which is special in the category, and for that we have a tag on that. Every material which is purchased, for that we have a tag on that. So we will find out the price which will be charged from the cost of goods sold, that will be depending on the actual inventory which is sold. So from the tag we will determine. So similarly, ending inventory, whatever the inventory is lying remaining based on the count, we will find out their cost. So this IAS2 prescribe you the three methods: first in first out, weighted average cost method, and specific identification method. So you can use any method out of three, but for that purpose you will be using it consistently. You will not be using that one year you use FIFO method, another year you use weighted average cost method, and third year you start using this specific identification method according to your choice. And if there is any change which is required, then you must mention in the disclosure requirements, disclosure practices as per the IES 2. So this is the methodology or inventory valuation model which is prescribed under this. So there are certain disclosure requirements also as per the requirements of this standard. First of all, you will disclose which accounting policy for inventories you have used. Number one, valuation model which you have used, whether you are using first in, first out method, whether you are using specific identification, weighted average cost method, which method you are using, what is the accounting policy of your organization, that needs to be stated. Secondly, you have to tell what is the carrying amount, what is the opening stock, and separately it has to be defined. It has to be defined for merchandise, for other kind of goods, for example raw material you have to define for finished goods, or in the work in progress. So material, work in progress, and finished goods, so these classification depend upon what is the appropriate for the entity. If you are a manufacturing concern, you will be having raw material, you will be having work in progress, you will be having finished goods. But if you are a merchandise organization, you are not producing anything, you will be having the finished goods which is purchased from outside and sold. So carrying amount of any of the inventories carried out at fair value less cost to sell amount of any written down values of the inventory recognized as an expense in the period. So sometimes what happens, you have the, according to your model of valuation, either FIFO or weighted average cost method or specific identification, you have the closing amount of inventory which is 50,000 only. But if you compare it with the net realizable value, that comes out to be 20,000 only. So it means there is a 30,000 gap. That gap is a loss, because now we have to recognize and measure the inventory at 20,000 only. The 30,000 loss which has to be, which has occurred, that will be expense in that period. Amount of, if any amount of reversal is there, that will lead to such reversal carrying amount of the profit. So that will be making treatment in the books of the account. So inventory will be valued at cost or net realizable value, whichever is less. So if we like to sum up the whole discussion on the IES 2, so as far as IES 2 is concerned, it is basically a model, a valuation. It presents a valuation model. It provides you the recognition criteria, how you must define the term inventories, what are included in the inventories, what is not included in the inventory. So in sum up, I can say as far as IAS 2, it defines the various kind of inventories which are a firm is having and hold for sale or for further processing. It may be merchandise, it may be raw material, it may be work in progress inventory, it may be finished goods. So similarly, merchandise, raw material, work in progress, finished goods, they will be defined as inventory. All other things which are not covered under the definition of all these things, that means goods purchased and held for sale, finished goods, work in progress, raw material awaiting use in the production process, they will be the elements of the inventory. So these are not particularly in the part of the inventory for which we have the different accounting standards. For example, for construction purpose, we have IAS 11. For financial instrument, we have IAS 32 and 39. Similarly, for biological assets, we have IAS 41. And the producers of agriculture and foreign products, forest product, we will be using the IAS 41. So similarly, the measurement criteria, cost or net realizable value. So we have discussed what is cost, what is net realizable value, and in cost also we include the cost of purchase, cost of conversion, and other costs. And similarly, we discuss what is not included in the cost, that is inventory storage cost, abnormal cost, administrative selling expenses. So similarly, a case study we also discuss and find out. This method has also, this valuation model as per the IES 2 has prescribed FIFO method, weighted average cost method, and specific identification method. So we have explained all this. So similarly, there are disclosure requirements which has been prescribed under this IAS 2. So IAS 2 is very much elaborated. It reduces the asymmetries It prescribes the recognition criteria, and it also prescribes the disclosure practices which are required for making the accounts more comparable, consistency in the accounting policies, and similarly it makes bring transparency through the various disclosure practices. So this was all regarding the IAS2. This lecture is basically to give you some inputs regarding the IAS2 so that you can be ready for further kind of discussions in the future. So thank you very much. So we will meet with the next lecture very soon.